Imagine waking up one morning and discovering that a small company you've admired for years is suddenly allowing ordinary people to become owners of the company. Not millionaires, not Wall Street experts, but anyone. A young bucking boy named Jake was scrolling through financial news when he saw a headline: Booga Tech startup raises billions through IPO. Jake stared curiously at the screen. IPO? Why was everyone excited about 3 simple letters? And how could a company raise billions of dollars in a single day? Curious, Jake turned to the one person who always seemed to understand finance better than anyone else, his best friend Emma, who is a financial expert, and she is beautiful too. What Emma explained next completely changed the way Jake looked at businesses, investing, and the stock market. But before we hear the explanation, if you're someone who wants to understand money, investing, stocks, and personal finance in the simplest way possible, you're in the right place. Make sure to subscribe and turn on notifications because every week we break down complex financial concepts into easy-to-understand stories. Now, let's get back to Jake and Emma.
Emma, I keep hearing this word everywhere. IPO. What the hell exactly is it?
Well, IPO stands for Initial Public Offering.
That sounds already complicated.
Not really, Jake. It's actually pretty simple. Think of a company as a pizza.
Okay, now you've got my attention.
When a company first starts, that pizza belongs mostly to the founders. Sometimes a few investors own slices too. But one day, the company decides it wants more money to grow. Maybe it wants to open new offices, build new products, or expand multiple branches around the world.
So that's why they need cash.
Exactly. And one of the ways to get that money is through an IPO. An IPO is when a private company sells its shares to the public for the first time after its formation.
It means regular people can buy pieces of the company?
That's right. Before the IPO, ownership is usually limited to founders, employees, and private investors. After the IPO, anyone with a brokerage account can buy shares.
So after IPO, the company becomes public?
Yes, that's why it's called going public.
But why don't companies just stay private?
Because growth can be difficult and expensive. Imagine you built a lemonade stand that became very, very popular across the whole town. Now you want to open 1,000 lemonade stands across the entire country. For that, you'll definitely need a lot of money. Instead of borrowing huge loans from banks or financial institutions, you can sell ownership shares to investors.
And investors give money to the company in exchange for the shares.
Exactly, you idiot. The company receives fresh capital and investors receive ownership. It's a win-win situation for both investor and company if the company continues to grow.
But who decides the price of those shares?
Before the IPO, investment banks work with the company to estimate its value. They look at revenue, profits, growth potential, competition, and many other factors. Then they set an IPO price according to the valuation of the company.
So if a company offers shares at $20 each, people can start buying them.
Yes, it comes in lots, say 100 or 200 shares in each lot. And once trading begins on the stock exchange, the market takes over. The share price can rise or fall depending on what investors think.
So that's why some IPOs skyrocket on the first day.
Exactly. If demand is very high, investors rush to buy shares and prices will jump rapidly. In some cases, companies change premium money for that also. But sometimes the opposite happens. If investors aren't impressed by the company, the stock price can fall. But remember one thing, IPO is not safe all the time. Some companies thrive after going public, others struggle. That's why investors should always do a very deep research before buying any stock.
So just because a company launches an IPO doesn't automatically make it a great investment.
Exactly. A smart investor always looks at the balance sheet instead of market hype.
Oh, right. Let me see if I've got this. An IPO, or initial public offering, happens when a private company sells shares to the public for the first time. Companies use IPOs to raise money for growth and expansion. Investors buy those shares and become partial owners of the company. After the IPO, the shares can be traded on a stock exchange, and their prices move based on supply, demand, and investor expectations. And most importantly, an IPO can create opportunities, but it's never a guarantee of success.
Perfect. Looks like you're ready for your next finance lesson.
And now I know what an IPO is and why it's one of the most important events in the financial world.
If you enjoyed this story and learned something new, don't you dare to forget to like, subscribe, and share this video with someone who's an absolute idiot and curious about investing.
Thanks for watching, and we'll see you in the next video.